Okay. So we talked about 3 different methods of depreciation on Friday and how to calculate each one of them. And so today we're going to look at what happens when estimates are revised. Like, let's say that the initial estimate for the life of an asset was 5 years. And either after 5 years or as it starts approaching that 5-year mark, management looks at this asset and it's like, well, you know, I think it may make it 8 years. So they're going to do a revision and they're going to slow the depreciation down to account for that extra life that they feel like the asset has. So that's one reason they could change, or it could be dropped down because it's been, let's say maybe it's wearing out faster than they expected, or maybe it's a machine that's become obsolete and they've got something better now. So they're planning on retiring it sooner than they originally had thought. So when new estimates are made like that, then we have to adjust for the depreciation we're going to take for the rest of the life of the asset. So to calculate what the revised depreciation is, we would take the book value of the asset, subtract the revised residual value, and divide it by the revised life. So let's put some numbers to that. All right, so on our example exercise, we have a warehouse with a cost of $950,000. It has an estimated residual value of $180,000 with an estimated useful life of 40 years, depreciated by straight line method. Okay, this is the original information. So we're going to calculate what the depreciation was originally, and then we'll look at a life, a remaining life revision. All right, so determine the amount of annual depreciation. Okay, so our formula is cost minus residual divided by the estimated useful life. So what's residual value mean?
It's the value of the asset just not being used anymore.
Right. It's the estimated value of the asset when they're done with it. That's right. So we'll take $950,000 and we'll subtract out that $180,000 that is the expected residual value. You'll see that y'all ever had a car that was a lease? Y'all are so, you're not really at that point. So if you ever lease a car, which think real hard about that before you do it, make sure it's a good fit for you. Holland's heard all this. I forgot you're in that class. Remember we talked about residual value? Do you remember that? It's the same thing. It's like, what's the car going to be worth at the end of the lease? So that's kind of what I think about. All right, and the estimated useful life, they said, initially 40 years. So if we subtract the 180 from the 950, that's going to give us 770,000. And then if we divide that 770,000 by 40, I'm getting 19,250, but it would probably be a good idea for somebody to check my math. You get the same thing? You got it? Okay. All right. So part B. We're 20 years into the life of this asset, and our book value at this point, book value is always going to be cost minus accumulated depreciation at that given time. So our book value at the end of 20 years is cost minus accumulated depreciation. And then our accumulated depreciation formula to help us find that number is annual depreciation times the years depreciated. So we'll plug our numbers into this formula. So our cost, remember, was $950. And then our accumulated depreciation is this formula here dropped in. So we said our annual depreciation is $19,250 times, how many years has it been depreciated? 20. Okay, so that depreciation amount, if you wanted that, is $385,000. So if you subtracted that 385 from 950, that's going to give you 565,000 for the book value. So at this point, at the end of 20 years, we have $565,000 of undepreciated cost. That's what book value is. The cost of the asset that we have not depreciated yet. Okay, so here is the estimate, the change in the estimate scenario. Assuming that at the start of the 21st year, the remaining life is estimated to be 25 years. Well, they initially said 40, and we've had 20 years pass, so they're adding an extra 5 years onto the life of this asset. Okay, residual value at this point, they're thinking it's going to be 200 instead of the original 180 that they came up with. So what we're doing now is to determine the depreciation expense for the next 25 years. So instead of using cost minus residual like we initially do, we have to use book value because we've already depreciated this asset some. All right, so we calculated that up here. So we'll just bring that down here. Subtract out the revised residual amount. So we've got 565 minus 200,000, and that's going to give you 365. And we'll divide that by the number of years they feel like it's going to be useful. So the answer to that one is 14.6. So now we're going to start using 14.6 for our depreciation expense where we were using 19,250. We're dropping that depreciation down because we feel like it's going to be useful for a longer period of time. Does that make sense? Just got to plug the numbers into the formulas. I can't honestly say I've ever seen that happen, but if it did, that's what you would do. Usually once they pick a life or something, they kind of stick with it. And then, at least in my experience, now that I'm in Mississippi, so I'm working in Mississippi, so my experience is probably pretty limited as far as practices by other businesses. But anyway, okay, so this is another example. Let's see, you work this one, but we'll do it together. Truck with a cost of $70,000 has an estimated residual value of 16. So remember, if you've got a residual value given to you, you're not going to depreciate that amount. You're going to depreciate up to that amount, but you're going to leave 16 in there. So that's why we subtract it when we're trying to determine how much depreciation we're taking every year. So we'll take the 70 and we'll take out this 16,000 of residual value because we don't want to depreciate that amount. We're planning on the asset keeping that amount of value at the end of our depreciation period. Okay, so then we'll divide that by 10 because they said estimated useful life of 10 years. And this is 54,000 if you're doing it in steps. So our annual depreciation is going to be $5,400. All right, so the next step is to determine the book value at the end of the 6th year of use. So the book value at the end of 6 years is going to be your cost minus accumulated depreciation. But we got to figure out what our accumulated depreciation is. So we've just calculated our book value. We can drop that in. And our accumulated depreciation at this point, something's wrong. What did I do? No, that's not book value. Determine the book value at the end of, okay, hang on a second. I get something somewhere. There's our annual depreciation, the book value. Okay, that's what we're calculating. Hello. So it's our our cost. Look at your paper. All right, we're calculating book value now. So we're going to take our cost minus accumulated, which is what our formula says. Okay, and then to get our accumulated, we've got to take this 5,400 times 6. That's how many years they're saying we've used it so far. All right, so this gives you 32.4 if you want that. And then at this point, our book value is 37.6. Have y'all got any questions? Because I kind of hit that there. Am I right? Kind of messed up and fumbled. Okay, so let's assume that after that 6th year is completed, that they decide the remaining life is 5 years. So if originally it was 10 years and we've already depreciated 6, they're adding an extra year on there. Residual value at the end of this 10 or 11 year period, I guess, after we add this extra year on here, it's going to be 10 grand. So we've got to see how much depreciation we need to expense every year for the remaining life of this thing. Okay, so revised annual depreciation will take our book value, which we just calculated, 37.6, and we'll subtract out our revised residual number. Then we'll divide that by the revised estimated useful life of 5 years. Okay, so I'm getting 55.20. So what y'all get? Yeah. Does that make sense? All we're doing is recalculating it. And the reason it's not going to, the fact that the residual value changes just means that's the point we will depreciate up to. We're not going to depreciate past that point. So it's fine if it changes. We just adjust the expense accordingly. So y'all kind of see what we're doing? No questions? Or you don't know what to ask or what? Or y'all get it? You're all good. Y'all are quiet. Y'all ready to get the heck out of here, aren't you? I feel you, friends. It's been a stressful semester. Y'all gonna be with family on Thanksgiving? Was that you? That was you? Okay. Who's gonna be with family on Thanksgiving? I can't tell who's talking. My family's small, so it's kind of like we will, but I don't have a great big family. So, and most of the grandparents are all gone, so we're going to go to my husband's mom's. There'll be a handful of people there, and then I think I'm doing something with my parents after that. So I like to cook it all. I got away with so many years of not cooking Thanksgiving. It was so nice. My kid's dad, his mom is great. She used to cook everything. They live in Grenada. She'd cook everything. And she'd start ahead of time and just put it in the freezer, the casseroles and stuff. She'd bring it all. Cook it. And when we buy the turkey, she'd bring everything else. And it's already made. We just had to heat it in the oven. I mean, I'm so spoiled. Now my kids go over there. So they come to town to my ex-brother-in-law's house, and they go over there and eat. So they still get the benefit. I may have a sandwich or something. If we don't go to Jim's mom's, but I don't know. My parents, I mean, I'll probably be cooking all this food this year. I can do it. I've done it before. It's just, I can cook. I don't like to. It's not a fun thing for me because I know what I have to clean up when I'm done too. It's just not a fun thing. Anyway, y'all got to make any food? Y'all enjoy it while you're young. And the guys can get away with, hey, you want me to pick up a sack of rolls or something, paper plates and plastic? Because when you're young, you think you got to drag out all the fine china and stuff because it's kind of fun. I can't tell you the last time I got all that stuff out. Paper plates it is, nothing to wash. Because all that fancy stuff has to be washed by hand. Anyway, yeah, fun times. You just don't know what to enjoy when you're young. You just, when you look back, you think, dang, I just had no idea how good I had it. Not having to cook. Y'all might like to cook. I don't like to cook.
I like
You know what? You sound like my daughter. She cooks and creates and makes a gigantic mess and then leaves it. So I feel like I'm always cleaning up the kitchen. I guess that's the price you pay for somebody else cooking dinner. Okay, so the next thing we're looking at is capital and revenue expenditures. All right, revenue expenditures. Okay, that's expenses essentially. Those are things that you're not going to add to the cost of the asset because it's just maintenance kind of stuff. Or maybe you're fixing something that's broken. It's not really a major thing. So revenue expenditures kind of sounds fancy, but it's kind of like the equivalent would be repairs expense, maintenance expense. It's just oil changes, rotating tires, lubing up machinery, or changing air filters and stuff like that. It's just maintenance. So it's ordinary stuff. And we're just going to put that in an expense account. Maintenance expense, repairs and maintenance expense. And then you would either credit cash or accounts payable, depending on what the payment agreement was for what you're having done. So oil changes, new tires, painting, engine repair, stuff like that. Engine repair. Now, when you start getting into major things like engine overhaul is something you do when it's like not running anymore and you have to kind of like totally rebuild it, right? Is that what an overhaul is? Any of y'all know, car people, truck people? This one's nodding. That's what it means? Okay. So if you get into something like that, then your asset was pretty much dead in the water and you had to do a major rebuild to get it running again. And an engine overhaul is going to add life to it because that should last a while, right? It's like getting a new engine, right? Okay. Do they even call it that anymore? Okay. Why are you laughing? Because I know what it is. All right. So costs that improve the asset or maybe extend its life. So an engine rebuild, that's going to extend its life. Otherwise, it's not useful anymore. It's just going to sit there. So, but if you're just replacing like a radiator or, I don't know, you're replacing spark plugs or what else do you do?
Battery, your alternator.
Yeah, batteries, just parts, just stuff that's going to break and you got to fix it. Yeah, obviously if you have to replace the alternator, it's not running without it. So it is going to extend the life, but it's not a major expense. If you have to like rebuild the engine or replace the engine, that's a pretty big expense. And I guess it depends on the type of vehicle you're working on, how expensive it gets. But you also have to think about, this is a, how much does a rig cost? Like 150? It can be anywhere from, a used one, I guess, could be anywhere from 50 to 60 to a couple $100,000, can it? An 18-wheeler rig, cab, whatever. So, anyway, extraordinary repairs, like an engine overhaul, that's going to extend the life. So in that case, you would debit accumulated depreciation. That's a very strange thought, isn't it? It would make more sense to debit the asset and just, you've got to depreciate the difference. Anyway, so we'll debit accumulated depreciation and then credit cash or accounts payable depending on how they're paying for it. All right, so asset improvements, that's costs incurred to improve the asset. So like a hydraulic lift, adding a lift to a truck so that you can, carry heavy things, and you're not having to like jump that thing up on there with a dolly. Doing stuff like that. Adding, like you've got a pickup truck and you add, what do you call that thing on the back where you like close it in like a camper? Is it a camper?
That's what I always called it.
Yeah. So you add a camper, the back cover thing to it so you can carry stuff and lock it up. That's an improvement. That's something you're adding. Okay. So what if we get rid of something and it, we got to get it off the books. If we're getting rid of it, let's say it's completely depreciated and it's just sitting over in the junkyard. Or in our junk pile. We got to, get it off the books because it's not being used anymore. So fixed assets with no residual value that are no longer used need to be removed from the books, from the accounts and the ledger. So let's assume in this example that equipment acquired at a cost of $20,000 has no residual value, is fully depreciated. That means your accumulated depreciation and your costs are the same. You have completely depreciated it. So book value is 0. On March 15th, the equipment is discarded. How would we record this entry? Okay, I mean, this is pretty easy. On March 15, you debit your accumulated depreciation. Because if you remember, when we would record depreciation expense, we would debit depreciation expense and credit accumulated depreciation. So we've been doing that all these years, and now this thing's fully depreciated and not worth anything, so we're going to get it off the books. So we're going to debit our accumulated depreciation for 20, and we're going to credit that cost. So we could say equipment. We're going to credit equipment for the cost of it, which is the same thing. So, I mean, essentially, the net effect of what you're doing, you're just taking it off. You're not really changing book value. But we don't want to leave something in cost or accumulated that's worth nothing. So, pretty easy. All right, so if it hasn't been fully depreciated, which means there's still book value there, you've got to record whatever depreciation it has. So let's say, for instance, if you're getting rid of something and it's not December, like if you just record your depreciation once a year and you're getting rid of something in March, you've got to record 3 months worth of depreciation before you take it off of the books. So that's what this is saying. Depreciation should be recorded before removing the asset from the books. If it's still not fully depreciated after that, then you're going to have a loss unless you sell it. But if we're talking about disposal, that means we're just getting rid of it. We're junking it. It's not good anymore. All right, so let's assume that equipment costing 10, no estimated residual, depreciated at straight line 10%. So the accumulated on December 31st is 6,000. But we're getting rid of this thing on March 21st of the next year. Okay, so how this works, you would think by looking at this, we've got January, February, and part of March. Well, if you're past the 15th of the month, you're just going to record a whole month's worth. So that makes it easier. We're just going to do 3 months worth. So let's see what our depreciation would be for a year. So $10,000 times 10% is $1,000. That's what our depreciation is per year. So how would we figure out what 3 months worth is? That's for 12. So we multiply this by 3 twelfths. So divide by 12, multiply by 3. So what do you have when you do that? I got 250. You can tell me if I'm wrong or not. So that's 250 expense for 3 months. You're just prorating it. You're just taking enough expense to cover those 3 months. And since we're past the 15th, we're just going to go ahead and take a full month's worth. Got it, 250? Okay, so the first thing we got to do is record our expense. So let's record expense for 3 months. So we'll just say March 21st, depreciation expense. Is $250, and we'll credit accumulated depreciation. What is this for? Equipment? Yeah. $250 we'll credit. Okay. So now we can record the disposal of the asset. So March 21, what are we going to debit to get an asset off the books? accumulated depreciation. So how much will we debit? 6,000 plus 250. So we're going to debit accumulated 6,250. Now we've already discussed that when we're disposing of an asset, we're not selling it, we're just getting rid of it. If it's not fully depreciated, which if it costs 10 grand and we've only got this much accumulated, it's not fully depreciated. So we're going to have a loss. And losses are debits. So I'm just going to go ahead and write this in here. Loss on disposal of equipment. We'll come up with a number in a minute. And then we'll credit equipment. I just know we're going to have a loss, so I'm going to go ahead and set it up that way. So when you get ready to do homework, you'll know to have a debit there. Okay, so what are we going to credit equipment for? What's the cost? No, that's accumulated. What was the cost of the asset? 10,000. It's just not fully depreciated yet. So we got to take the whole amount off. We're getting rid of this piece of equipment. Even though we don't have 10,000 of depreciation yet, we still got to take the whole cost off. So what's the difference between 10,000 and 6,250? How much? 37.50. That's going to be the amount that we are losing by getting rid of this equipment because we paid 10,000 for it. We're not getting anything for it at the end of its life because apparently it's worthless. Maybe it got something got dropped on it and it got crushed, or who knows? Maybe it was defective and it just quit working and it was past the warranty period. Who knows what it is? It's just not useful to them anymore for whatever reason. And they have recognized depreciation over the years, you know, for using it and the loss of usefulness, but they're at a point now where they're getting rid of it and they haven't fully depreciated it yet, so they'll have a loss. Does that make sense? No? Yes? Y'all are just looking at me. Yes? No? Tell me something. Are you good or no? Thumbs up, thumbs down. Nothing? Are y'all alive? Are you like, you don't know enough to know whether you're good or bad? Is it, y'all getting it? Are you cool? Do we? It is new material. That's true. That's a good answer. I just need to make sure I don't like leave you behind. I can't remember if I got this one. Okay. All right, so let's move to the next part, which is similar. We're just adding the fact that somebody's buying it now. We're selling it. Okay, so we're going to, the entry to record the sale of a fixed asset is just like the entry to dispose of an asset, except now we have money involved. So we might have a gain, we might have a loss. It depends on how much we're selling it for compared to what the book value is. All right, so in this first example, we have equipment that costs $20,000 and it has no estimated residual value. Depreciation is straight line 10% each year, and the equipment is sold for cash on October 10 of the 8th year. Accumulated depreciation December 31 of the previous year is 16,000. So we've just got to figure out how much depreciation do we have for this year and add it to that. Okay, so our annual straight line depreciation is 20,000, which is the cost of the equipment, times that 10% rate they gave us. So $2,000 of depreciation expense every year. So if we're gonna calculate depreciation for January through October of this year, to add to this 16,000 that came from last year, that's the total that we've depreciated throughout the life of the asset through the end of last year. So for this year, we've got $2,000 times 10 12s. You got 10 months through October. So 10 months out of the 12. So we'll just multiply 2,000 times 10 and divide it by 12. So that gives us a lovely one of these numbers that never ends. You want to round it to 1667, that's fine. So what we're going to do to determine our accumulated at the time of sale, we'll take that 16,000 that we had through last year, and we'll add, just round it to 1667. I hate these fractional numbers. It's irritating. But of course, again, that's because I'm making the problems. They don't always come out nice and neat like they do in my book. All right, so accumulated at the time of sale, 17,667. Does that make sense? Okay. We sold it for cash. So how much cash did we sell it for? So we got to record the depreciation first. This is our first step. We got to record this 1667. So that's easy. Have a date on it? October. It just said October 10. Okay. You know what though? I'm thinking, with that being on the 10th, do we take a full month or not? I'm thinking we do not. We'll double check this up there. That's the only tricky part. Depending on when it falls in the month, you may or may not take a full month of depreciation. So let me see. Sometimes the book's kind of clear, sometimes it's not. Yeah, that's it. Since it's fallen before, okay, so let's back up a second. Since it's falling before, we'll make a note up here. If date is before the 15th. How do I say this? Don't include that month. Now read my handwriting. Okay, so if the date is before the 15th, or the 15th and before, what did I say? To get this specific. Don't y'all love how specific this crap is? This is the kind of stuff that drives people crazy. Drives them to higher accounts. I know it's in here because I remember saying it. Because I was questioning it myself when I was looking at it. Which is not wrong. I mean, you would do that, but it's a weird cutoff. Okay, so let's just say if it is before the 15th, we are not going to include it in the depreciation expense. If it's after the 15th, or the 15th and after, then we will. So in this case, we'll only take 9/12. So that is going to be the difference. All right, so if we take 9/12 of 2,000, is that 1,500? That's a nicer number. And And it may be your clue in that you've used the wrong period of time if you get that funky long number that has to be rounded. Let's see if I can find the exact date. It's just not telling me. In the old book, it tells you what day. They're pretty clear, though. They don't pick it up if it's before the 15th. Okay, so anyway, 1,500. So we're going to add 1,500 here. So our accumulated will be 17,500 when we get to that point. So just change this to 1,500. Okay, so remember that cutoff is the middle of the month. All right, so calculating the gain or loss of a fixed asset. All right, so the next step is to record the sale of the equipment under each of the following scenarios. So evidently we've got a couple of different possibilities here. So your sales price minus book value is going to give you your gain or loss, depending on whether it's a positive or negative number. And remember, your book value is cost minus accumulated depreciation. So looking at this piece of equipment, our book value is $20,000 is our cost, 17,500 is our accumulated. So we've got 20,000, and they've got it to where we can add the two together. So 16 was what we had at the beginning of the year. We just took 15. So y'all following what I'm doing? 20,000 minus 17,500 gives us 2,500 for our book value. So I get the same thing. Okay, so our sales price. I get the sales price. Okay, the equipment is sold at book value, no gain or loss. So our sales price would be $2,500. I think y'all are wearing off on me. I'm not reading the entire instructions. Okay, so in this scenario, we have equipment's being sold at book value, so there will be no gain or loss. So our sales price and book value will be the same. That's how we had to figure out our sales price. It's the same as book value. Equipment sold at book value. Okay. All right, so in this situation, we would debit our accumulated depreciation for 17,500. We would debit cash because we sold it for cash, $2,500, and we would credit equipment for 20. No gain, no loss. Sold it at what it was on the books for. Okay, so in the second scenario, we're selling it for an amount below book value. So we're selling it for $2,000. That's what they're telling us. It's below book value, $2,000. So our sales price is $2,000. Our book value is $2,500. So we're going to have a loss of $500. So in this case, we would debit accumulated depreciation equipment for the same amount. You're going to debit cash for $2,000. We have a loss, and losses are debits, gains are credits. For 500, and then credit equipment 20. It's just kind of giving you an example of what each situation would look like: a loss, gain, a break even. Okay, so what if you sold it at an amount above book value and you sold it for $5,000? So $5,000 is our sales price. What's our book value? How much? $2,500. So in this case, we have a $2,500 gain. That's better. So again, we're always going to have the same accumulated depreciation for each scenario. It's going to be the same. 17.5. We're going to credit equipment every time for 20. So you could always, if you have 3 scenarios like this again, you can just drop in, the stuff that's not changing. So we'll debit cash. This time we have 5,000. So what do we need a debit or a credit to make this work? Credit. So we'll have gain on sale of equipment. If you can't remember which way it goes, gain on the right, loss on the left. Huh? Was there what? 56. I'm sorry. You are correct. I saw 5. 56 minus 2,500 is 31, right? It's a bigger gain. So in this case, we would have cash 5,600, gain 3,100. The other numbers would stay the same. Sorry about that. It's just dropping numbers in. Y'all understand what's happening in each situation though? No? You're selling it for more or less than you have in it, essentially. Okay, these are examples kind of using I'm just seeing what we got here. Calculating depreciation, calculating gain or loss. We're about to be through. Okay, we'll quit there because we still got, some examples to work. But I'll make sure that your examples for homework are to involve. I don't kind of dip into what we're doing next time. Okay, y'all have a good one.